When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Vogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Vogan. And now here's Jeff Vogan and Jeff Shea.
Thank you so much. Welcome to Premier Retirement, the show that gives you the straight talk and honest answers you need to reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about whether or not we should buy the dip or stay the course. Also, 2/3 of investors are worried that they'll outlive their assets. We'll talk about that. We'll also answer some listener questions and then a late start investment plan. If you're late to the game, it's never too late to start. My name's Jeff Shea, and as always, I'm just here to ask the questions with the words of wisdom and solid advice. Of course, they come from the other Jeff in this radio program. It's Jeff Vogan, founder and president of Premier Retirement Planning and Wealth Management. Hey, Jeff, how you doing today?
Doing great. Always good to be with you.
Always good to be with you as well, Jeff, and certainly glad to be with all the fine people here of the greater Tucson area. A lot to talk about on today's show. Before we get started, I want to give the telephone number. It is 520-780-9059, 520-780-9059. If you hear anything in the radio program today that piques your interest, you'd like to talk to Jeff about your individual plan, just give that number a call this weekend, 520-780-9059. Well, Jeff, the stock market has been a bit volatile here in the past week. The stock market is plummeting amid tariff mania. So should you buy the dip or stay the course? What do you think about this one, Jeff?
Well, there's a lot that remains to be seen, I think. I think that, if you are a trader, then you buy the dips, and you should have been doing that all along. If you're a buy and holder, because you've got 10 years between now and retirement, you continue to dollar cost average in, you keep putting your 401k money in it, you keep on making your weekly deposits, so you keep buying while the dips are low, and later those stocks will return to a higher value, hopefully. But if we look at the market, and what I've been saying for a couple of years now is the market is so overvalued. And by the way, this dip does not make it fairly valued. I mean, fair value based on historical price earnings ratio is still down around maybe the high threes for the S&P, like 3,800, 3,900. And that's based on estimated future PE ratios. If you look at the PE ratios, trailing 12-month PE ratios, which normally run around 15, and we're at somewhere around 35 to 38 now. I think it's probably down to 35 now with the last couple of volatile weeks that we've had. But if we're looking at that, we're looking at less than half. So the stock market being in the low 5,000-ish area, which is what it is while we're recording here today, a couple of days later when it airs. So we might be slightly off in a day or two this weekend. But we're looking at potentially in the twos, 2,500 in the high twos if we get to what the typical market correction / crash does. Now, people wonder why market corrections are called corrections isn't correct. It's supposed to be the market goes up. Why is it called a correction when it goes down? Well, the reason it's called a correction is because it corrects to a fair, more reasonable value. I mean, people have been overpaying for stocks, and it's been largely wealthy people that have been driving the market and enjoying the greatest run-up in history, especially with all the stimulus money and all the availability of extra capital that the Fed's been printing, which typically goes to the wealthy, hedge fund managers, big corporations, officers of those corporations, owners, et cetera, et cetera. And so, I just heard a stat a few days ago that 10% of the wealthiest people own roughly 88% of the stock. The rest of the 90% of people own the other 12%. And by the way, the bottom 50% of households own zero. So basically 10% owns 88% of the stock market, and 40% of the population, private households, own 12. That's it. So the interesting thing is during the last couple of years, a lot of the wealthy people, especially the pension funds, the hedge fund managers, the banks themselves, have been unloading stock, and the private investor has been increasingly acquiring stock and continuing to do so at a price that's ridiculous, in my opinion. If you would go out and buy a Toyota Corolla, I'm just picking a car that's typically very reasonable price. Let's say the most loaded Corolla you could buy is $40,000. And right now, because everybody likes Toyotas because they're such great cars or whatever, people are willing to pay $150,000 or $200,000 for a Toyota Corolla. I mean, you think people are crazy, yet people are still doing it. Well, there's a lot of people that have been buying stocks that way, buying stocks that have price earnings ratios in the hundreds, that are trading, that have earnings growing at 20 or 30%, yet they're never going to even catch up. The earnings will never catch up to the stock price, maybe for 20 years or so. So why are we paying that much? shouldn't we just wait for the next recession and wait till the Toyota Corolla gets down to 40,000? We'll buy one then and just kind of make do with what we have, or just kind of ride this thing out. Warren Buffett's been showing that lesson to us by hoarding cash. He was a few days ago, over 350 billion in cash. And now he's a guy that would buy on the dips. Now, I haven't seen him jump into the market quite yet. He's probably waiting a little bit for it to shake out. So for a true correction, we've got to go well below where the market is right now. Typically, when we hit what's called bear market status, down 20%, which we did, I think, on all three indexes, at least the S&P and the NASDAQ have, we call that a bear market. Last time that happened, there was two times just in the recent 4 or 5 years that's happened. The COVID crisis, shut everything down. Everybody got scared and ran for the sidelines, and market plummeted a little over 30% in about a month. And within a couple of months after that, the market was back to even. That was a dip, and that was kind of an unprecedented sell-off. But back then, the stock market wasn't as overvalued. It was probably maybe 30% or 40% less overvalued than it is right now. And after that, the market, they got all kinds of stimulus money. The Fed printed money, and we had all this money to put into the market, and it kind of drove the prices up because nobody had really anywhere else to put it other than household improvements and things like that, which also made Home Depot stock and builder stocks and housing stocks go up as well. So it kind of fed on itself for a while. And then every time we wanted the economy to look good, we just pumped the market. But the economy and the market has not been correlated. It hasn't been for a long time. Now, eventually, the market will succumb to economic forces, and the economy will eventually show up in the market, but it hasn't for the last few years. As I've been saying and pointing out over and over again, we've got an inverted yield curve. We've got more private households owning stock than ever before, which is really the dumb money that owns the stocks that are buying based on news flashes and buy the dip strategies and all that kind of thing. Well, as long as we know it's going to keep on getting propped up by Fed printing money, that's fine. And it has been. And so if we believe there's going to be QE to infinity and that the people in power aren't going to let the market correct, then we just keep buying. And the last few presidents that have been in power didn't mind doing that. Even during the COVID crisis, Trump kind of followed the guidance that he was given to do some stimulus and things to help us bail out of an imminent problem that we had to fix. But after that, during the recovery program through the 4 years that Biden was in power, we had tons of stimulus because the market finally started selling off and getting back to equilibrium. It should have kept going. The problem is we had a lot of Fed intervention. The Fed faked money out. They told investors that they couldn't get paid from their renters on the commercial side and the residential side. People didn't have to pay their mortgage. Banks were losing money, but the Fed says, oh, don't worry about it. You don't have to declare those as losses. Those loans don't count. We'll just fund them for you. Now, the Fed and the banks are partners, and they're not a government agency, by the way. So, they're a private agency basically that was set up, I guess it was set up as authorized or allowed to happen in order to build some sort of a safety net, or at least a perceived safety net, so it would look like the banks are strong. And so they get to play all kinds of money games and accounting games to make the banking system look like it's strong and thriving, and that even the economy is doing well, even when it isn't. We've had economic indicators. The economic indicator index has gone down, just regularly over the last, actually a few decades, but regularly over the last 2 or 3 years. So in other words, the market sell-off in 2022 never really got finished because we just started pumping money back in. According to my understanding, and I do a lot of research, and some of it I believe might be a little skewed or biased, but most of I try to only spew or repeat things that I believe are relevant and accurate. Supposedly the Fed actually ran out of money. Basically, they can't really technically print money. They really don't have based on the bond market, they can't buy and sell bonds like they used to. So they can't manipulate like they have been. So they've been just giving debt forgiveness to the banks that are supposed to be paying off the loans that the bank term funding finance program that helped the Silicon Valley Bank and other banks, not break the banking system. Several banks went out of business, but the Fed came to the rescue and created that bank term funding program where they took on all the bad debt and said, oh, we'll handle it. Don't worry about it. You don't have to pay it back. You just have to buy it next year, which was March a year ago. And it didn't happen. So the banks have been propped up kind of unnecessarily and, in my mind, irresponsibly, but it's shown up in market growth. Now we are getting seriously wealthy. Some of the middle class are enjoying it. And some people are complaining about, oh, my 401k, it's going down. I'm losing so much wealth. Well, you're not really losing so much wealth. In my opinion, the gains were unrealistic and unsupported and really shouldn't have happened to the extent that they did. And by the way, in the future, they will, and they'll probably justify themselves. Bottom line is this bear market that we're in is what I think is a start of a correction that may continue, especially if there's a lot of fear and what we call capitulation that enters in the market, and it might. But even on a fundamental basis, I've been saying we've been due for a market correction for quite a while. If we go back to realistic valuations, it should be lower than where it is right now. So If you're a trader and you want to buy the dips, or if you're a long-term investor, then you keep holding, you don't worry about it, and you continue to put money in, because eventually all those stocks are going to rebound and things are going to get better. We're going to have a recession or a reset period. However, if you're living on that money month to month, you shouldn't have been in the stock market anyway for the last few years. Now, if you look back, you'd have been lucky that you were. Oh my gosh, I got to pay all my bills on NVIDIA stock. Woo. Well, now NVIDIA stock's down 30 or 40%. What do you do now? Well, if you bought NVIDIA at $20 a share and it's still at 90 something or 100, well, you're still making money. But if you bought it at 130, like the majority of stock owners right now, the retail stock owners bought it in the neighborhood of between 120 and 140, they're all down. You're going to be taking a loss. So there's different strategies for being in the market. We like indexing through principal protection. You know, the life insurance products and the annuities that we hold are the winners right now. They're the things that making everybody, happy. I only after 2 weeks, I got my second call yesterday of somebody that wants to call for reassurance that everything's okay. I usually send out some, mass emails and things like that. Say, hey, remember, if your profile is to keep it safe, we're still safe and we're not losing money. Don't worry about it. Remember, you put money in principal protection. The other thing is some people do have a portion of their assets that are in the market. And if that portion is money they can afford to wait on or lose, then we kind of ride it out, we rebalance, and we try to take advantage of these lows. And we'll probably buy in a little bit more as it goes down. If people get nervous and this is too hard to stomach and you can't handle the stress, riding the market down, even if it might be the smartest thing, if it's an emotionally bad thing for you, you might be better off just making a flat interest rate and knowing you're not going to lose money. That might create a much longer, healthier life for you than if you're stressing about your money all the time. So again, a lot of it depends on your demeanor, depends on your risk tolerance. Everybody's different. Some people have enough money that they could lose half of their assets and not worry about it. And if that's the case, then let's stay in the market and keep trying to buy stocks when they get to a value that is really good. Lately, in our growth portfolio and the stuff that we manage that does have risk, we've been very careful to buy predominantly the stocks that aren't overvalued, stocks that have price earnings ratios of 10 and 15 or less than 20, that still have growth of over 10% a year, or expectations of growth in a good industry, nuclear energy, for example, energy transport, energy in general. Utility stocks are still holding up pretty well. Some of the consumer staples aren't doing too bad. There's some areas that we can still buy value, but even still, just the mass sell-off and the fact that there's scared money, there is so much scared money in the stock market. And that is what I mean, private households that don't understand the market, that typically are scared out of it. They're going to drive the market. They're going to drive it down. They're going to probably bail out. They're probably going to get scared. And a lot of day traders that really thought they were day trading gurus because the market kept going up and they made more money than they lost along the way, they think they're pretty smart. And all of a sudden now their trades aren't working because the market's being manipulated. See, we've got market makers trading stock with a bid and an ask price. And if you don't know what that is, basically a bid is what they'll buy the stock from you for, and the ask is what they'll sell it to you for. And typically blue chip stocks will have maybe 1 penny of difference. So if they sell 1 million shares of that stock, they get 1 million pennies. Well, guess what? 1 million pennies, $10,000. Now what they're doing is the spreads are like $1 and $2 a share. Buy NVIDIA for 101 and they sell it back to you at 103, or I'm not picking that stock in particular, but I'm saying that because it's a stock people know. But many big stocks are trading at dollars difference. So you sell 1 million shares of stock now, you're making $1 or $2 million instead of 10 grand. These banks are cleaning up right now based on the fear of the trader. So don't get scared. Stay the course. If you have a plan, look at the plan. Was your plan to be in the market with 20% of your money and not worry about it and continue to rebalance if the market changes and live on the other 80% of your money? Fine, because it pays all your bills. If that's the case, then write it out. If you weren't a client and didn't have a plan and you're listening to this right now and you had all your money at risk, you might be very, very nervous right now. I had a person come in that was up to about $1.4 million a year ago, had a bunch of the high techs and the big movers and shaker stocks. And when he came and saw me, it was worth a little over $1 million. And based on that, he says, I'm going down the wrong way, yet the markets really hasn't done that bad, but I'm doing worse. I said, well, how much could you afford to live on? He said, well, I could afford to live on less than that, but not if it keeps going down. Well, right. Well, maybe they should have thought that and had a plan to take half or 3/4 of that off the market or out of the risk bucket, back when it was around 1.4, keep $1 million in safe money, live on that fat and happy $60,000, $70,000 a year, and then let the other ride. But now they're under $1 million because of these market corrections. And now it's like, oh, now I really can't be in the market because if I lose more, I can't make ends meet. And I know if I at least take the risk off the table, I know I can live happy for the rest of my life. So they're in a different position now. Obviously, it's a position you don't want to be in. The difference is that these particular people need to live on that money on a month-to-month basis, a day-to-day basis. And it's not like they can just sit and wait for it to come back, because every time if the market keeps going down, they're going to continue to lock in losses as they pull money out to live. So again, you have to kind of find that balance. And here you go again. You ask me a simple question, and there's a long 20-minute answer. The answers to most questions, as you know, are it depends. It depends where you're at. Do you write it out? Well, it depends. Do you want to? Or even if you could write it out, do you want to? Is this causing your stomach enough gut ache that you just want to sit on the sidelines and kind of wait for things to shake out? Honestly, if you look at history, most market corrections should shake out back at more of an equilibrium PE ratio. If you look at history, there's a Shiller price, there's what's called the CAPE adjusted price earnings ratio. It's a Shiller PE ratio graph, and it'll show you based on where the price earnings are right now, what the next 10 years in the S&P will average. And right now we've got an average of -2 to +2. It's basically a break-even decade ahead of us in the stock market. So if you want to just write it up and down, history shows that we've got some corrections and some recessions ahead. If like the 2000 decade, after we had the dot-com bubble that blew up, and now we've got the AI bubble and multiple bubbles that are ready to pop. So if that happens again, it wouldn't surprise me if we had a repeat of the 2000, 2010 decade. How are you going to solidify your living if you're relying on those savings? My opinion is, even though the market has gone down 20 or 30% from maybe where you were a few months ago, you're probably still at a much higher place than you were a few years ago. You should count that as a blessing and say, hey, am I still able to live on this if I don't lose any more? And if that's the case, then take half of it off the table and make sure that it provides guaranteed income for the rest of your life. Maybe move some into a tax-free situation. Maybe it's money you don't need. If that's the case, do a Roth conversion while the money's getting lower in value, so you have to pay less taxes when you move the money from an IRA to a Roth. There's all kinds of strategies we can use to take advantage of this lull in the market, but freaking out and bailing out when you don't need to isn't a good option. Freaking out and not bailing out, knowing that if you lose more money, you're going to possibly have to downsize your house or move in with your grandkids or something to live, is not an option either. So again, everybody's different. Everybody's got a different situation. Just make sure that this market isn't derailing your financial future.
Talking with Jeff Logan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. We're talking about the volatility here in the stock market and whether or not you should buy the dip. Once again, if you have questions of Jeff, you'd like to sit down with him and have a consultation, we call this the Retirement Roadmap. You can get it absolutely no cost, no obligation by calling 520-780-9059, 520-780-9059. Just a casual conversation between you and Jeff to talk about the market, really anything that applies to your retirement journey. Once again, it's no cost, no obligation, 520-780-9059. You can also find out more about us online at premret.com, Premret.com. Jeff, we've talked about whether or not you should buy the dip, but what should you do if your 401k is losing money?
Well, it depends what stage you're in your retirement plan. 401k is where I like to have you take all the risk if you've still got a few years before you need to retire. And that is because you automatically buy all the dips because you're putting money out of every paycheck into the market. That's how you should get into the market. That's how you should grow your assets in the market. More of our clients are retired than aren't retired. Most people start looking at us when they're getting a decent nest egg together and they're getting ready to retire, and they want to start protecting it and starting making some sort of a plan with it for income, because they really can't do anything until you're 59 and a half with that 401k except just continue to grow it. So if you're 5 or 10 years away from retirement, I wouldn't worry as much about it. If you are getting really close to retirement when you know you're going to need some of that money, you ought to consider taking some of it off the table. If you're needing that money to live on in the near future, even in the next probably 5 years or less, maybe even 10 years or less, depending on your comfort zone, or maybe you're like a client that just emailed me this morning that said, hey, Jeff, I somehow lost my job yesterday and I got my 401k. I need to start looking at it for income. Well, he didn't see that coming. I know that he had planned to work 5 to 7 more years based on our income plan. And he probably lost a few bucks this last week or two that had he known he was closer to retirement, he might have wanted to take some of it off the table. Now, he has taken some of it off the table, probably 40 or 50%, but maybe in this point, he might want to take a little bit more off because he can't afford to lose that last few $100,000 that's in his 401k that he hasn't already moved to a safer spot. When I say safer spot, you can still get upside in the market. You can move if you're 59 and a half, or if you've separated from your company from an old 401k that you maybe moved and are still managing it yourself. If you left that old employment, if you're not 59 and a half, you can still transfer those assets to an IRA and self-direct it. We manage those funds for a lot of clients where, a 401k might only give you a few options or one fund family to deal with, or maybe no annuity options. And you might want an annuity that will guarantee you a guaranteed amount of growth until you retire and then income for life. We have a plan that we love for IRAs and 401ks 5 or 10 years out from retirement, that you can move it into an asset that, if you back test it, this asset, if you could have bought it 10 years ago, it would have averaged better than what the market did, 12 or 13% net of fees. The other thing is because the company doesn't risk your principal, they leverage the interest that they make on your money. The principal is not risked, and they allow that to grow exponentially in market-related indexes. We call that index annuities. I've talked about them several times. Wall Street hates them because, you basically park your money there. It's long-term income. There's not a lot of trading, not a lot of commissions to be generated. So again, if you move it to the index annuity, if the market keeps going up, you'll keep making money. If the market goes down, you don't lose. The other thing is they have income riders that guarantee lifetime income. There's a couple of them that give 20 or 30% bonuses. Now, that's not real money. If you get hit by a truck, your family doesn't get 20% bonus. The company, can't do that. But what they do is they credit it towards an income fund that you can use if you pull out your money over a period of time. Let's say if you get 20 or 30% upfront as a bonus towards income, you put, let's say, just $200,000 of retirement money in there. Just use a number. They give you 30%. It goes up to 260, and then it grows at 8% a year from there for the next few years. So in just a few years, it's going to be $300,000 in guaranteed income value, even if the account that you put $200,000 in hasn't gone up a penny. And so income at, let's say, a 6% payout that they would guarantee at, let's say, age 65 or 70 or whatever the age is that you decide to pull the money out, let's say at 6%, well, 6% of $300,000 is $18,000 a year, $1,500 a month. Whereas, 6% on the typical annuity or even a low risk investment might only be maybe $1,000 a month. So you get a lot better guaranteed interest. You can take some of the risk off the table and know that when you retire, or if unfortunately you get bumped out a little bit earlier than you had planned, that you've got these assets in place that'll fill in the gaps for the income that you can make based on the difference between Social Security, which you might have to take early if you get retired early, and what you would have had if, the market crashed. Then they fire you, and then you realize that you can't convert that drop in value in the portfolio. You can't convert that new portfolio value into enough income to make ends meet. So again, there's ways to continue to lock in profits along the way. You never get hurt locking in a profit. And the other thing is to replace those profits with guaranteed future income so that your retirement you can be calm, cool, and collected in retirement and have that peace of mind that people deserve in retirement. You can retire on your own terms and then only risk in the market what you can afford to let go up and down so that you're not worried in times like these. Like I said, we've got hundreds of clients, hundreds of managed accounts. And I received one call like the second or third day the market crashed a week ago. And so far one this week. So we're not getting people rattled. They already know what the plan is. And we just have to move ahead. If you're not doing that, I suggest you find a way to get peace of mind and not just trust the market and do the hold and hope retirement method, because it's uncertain. And I think people want certainty in their retirement, or at least predictability.
Our show is called Premier Retirement. We're talking with Jeff Hogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. And we've been talking about what to do here during this market downturn. Should we buy the dip? And what we should do if you're worried about your 401k. Again, if you'd like to talk to Jeff, 520-780-9059 is our telephone number. Go ahead and make that call this weekend. Leave your name, telephone number. Shelley will call you back and set up an appointment for you to talk with Jeff. 20, 30 minutes, whatever it takes, just a casual conversation. We're not going to try to sell you anything. We're just here to answer your questions about your journey towards a confident retirement. And again, we can talk about pretty much anything that you want to talk about. 520-780-9059, no cost, no obligation. You can also find out more about us online at premret.com, premret.com. Jeff, time for a break. Coming up next, listener questions and more when our show continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Hogan and Jeff Shea.
Thank you so much for making us a part of your weekend. You're listening to Premier Retirement with Jeff Ogan, founder and president of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. We've had a great first half of the show today talking about whether or not you should buy the dip in the market. If you've missed that or you want to hear this whole show over again, go to wherever you get your podcast, search for Premier Retirement with Jeff Ogan. You'll find this show and many of our past shows so you can stay on top of your journey towards a confident retirement. You can also Google Premier Retirement with Jeff Ogan, and it'll point you to any number of platforms where you can hear the show. Also, a reminder, we're on for you 4 times a week, actually, here on the radio on KNST. Saturday, 7 a.m., 9 a.m., and 1 p.m., and then also Sundays at 11 a.m. And again, we're on your schedule with our podcast. Jeff, time for listener questions. Let's dive in today with Keith, listening to us in Oro Valley. Keith says, I'm heavily invested in Apple stock and I'm worried that the company is dependent on Chinese and Asian suppliers. With the tariffs and trade wars, I'm really worried. Should I get out now or try to ride it all the way through? What's your opinion?
Personally, I made money shorting Apple stock lately, but that's because I don't own a hoard of it. And I don't know if I should have said that. It's kind of rude. But I think anybody who has a heavily invested in Apple stock, I don't know if that means the majority of your portfolio. I mean, I've met a few people that have tens of millions in Apple because they bought it early and never sold any, but that's all they have. And I'm not sure why they haven't diversified yet. There's a lot of other stocks that have done well. The Magnificent Seven, you could get good growth on Meta, Amazon, Google, and Netflix as well. Tesla's been good for a while and maybe will be again. But there's a lot of really good, solid stocks that have upside and are a lot more diversified and a lot less dependent on China, perhaps. Apple's a big company. I don't think they're going to go out of business anywhere, but the stock might suffer a little bit, as you know. But then again, so are all the Magnificent Sevens, which were overpriced, overvalued, and maybe getting back to more sane levels as the market corrects. But I always believe in a more diversified portfolio. I also don't think it's ever a problem taking profits. If you're invested heavily in Apple stock, you've probably owned it a long time. You never get hurt taking profits. If you're starting to get worried that Apple stock is going to go down to a point where you can't take advantage of some of those profits, or you don't want to sell to live on it because you're getting close to retirement. I mean, this is your retirement portfolio in an IRA or whatever. It doesn't matter, if you sell inside the IRA or not, you're not going to get any hit with any taxes. If you have it in a non-qualified or non-IRA account, obviously there's probably some capital gains that you might need to pay, but capital gains are a lower tax bracket than your ordinary income is too. So you have to kind of look at your entire tax situation. Is it worth taking profits and paying taxes on it? Or do we just ride it out because you have so much Apple that you'll never go broke? It doesn't matter. I don't know, what your number is, but you could be heavily invested in Apple. It could be $100,000 out of a $200,000 portfolio. It could be $20 million out of a $25 million portfolio. I don't know. Obviously, the answer and the recommendation will be different on each of those scenarios. However, I would say diversify them. It's just kind of the standard rule of thumb is you take some of the profits off the table and you buy the next Apple or other stocks that are solid companies that are dominators in their industry. You might want to also dabble into some of these up-and-comer companies that have technology that are going to support AI. There's a lot of things, just like you had a hunch with Apple years ago that it was going to do nothing but grow. There's other companies that are getting into that bracket now. I think some of the big ones that we've heard about for a long time are a little top-heavy and only have so much growth potential from a percentage basis, whereas maybe some newer upper-coming companies might be good to play with if you're kind of a speculator and you like to make money over the long haul. But if you're worried about Apple stock correcting, maybe you've got what I call scared money in that investment. If that's the case, maybe take some off the table, put it in the index fund that'll go up with the market when the market goes up, won't lose any money when the market goes down, and might provide you with that retirement income you need so you don't have to sell Apple to live on, especially when it's down in value, when China trade becomes a problem or some other issue happens where a patent gets infringed on, or maybe they get sued out of something. I mean, who knows? The Apple brand is certainly a dominant brand, but does it have to be forever? I don't know. I would imagine it probably will be. But the fact is if you're putting your retirement sanity and well-being and peace of mind based on one stock, it seems to me I would be very nervous doing that personally. And I think I'd be nervous for my clients if they were doing the same thing. So you might want to look at diversification, not necessarily into other stocks, but maybe taking some of those profits off the table and putting them in a place where you're guaranteed growth, guaranteed against loss, and guaranteed future income so you don't have to worry about your Apple so much.
Jeff, for companies like Apple that are highly dependent on Chinese tariffs and Asian countries and that sort of thing, do you think that these tariffs are going to have a continued effect on these, or do you think that this is just something that's going to pass sooner than later?
Well, I don't know. There was some times, I think back in the World War II era where they started doing some tariffs and didn't work out that well. But of course, there was other things that were contributing to the cause of a stock market getting hammered. I think around recession time, the Great Depression time, rather, there was some tariff negotiations that didn't work out well. So they don't always work out that well. However, I think America is a dominant enough country with enough, and if we get enough production here, other countries will depend on it. So I know that, or I have a very strong feeling that the tariff situation will work out. I think Trump is smart enough to know that it's a negotiating tool to bring people to the table. It's already done so. We've got, last I checked, over $5 trillion in committed investments in America in infrastructure and jobs, basically, building companies, corporations, bringing manufacturing back, manufacturing that we lost to other countries. Yes, it might be a little bit, actually, it might cost more to make stuff here. The taxes that these businesses pay here will offset some of our income taxes. So we'll have actually more disposable income to buy those things, even if they are a little bit higher in price. I don't mind being in America first. We've been America last for a lot of times. I also don't mind supporting the world and making the world a better place. But I think as America can thrive, I think the other countries will thrive better if they can enjoy free trade with us without tariffs, and if they can allow us to ship products in without tariffs as well. I mean, anything made in the U.S. is going to cost more at the other end than theirs anyway. So it's not like India and China can't already be the dominant player and the most competitive product producer in their own country, and yet still give those people that want American brands and want some of the stuff that we do, which I think is generally considered high quality stuff, and maybe the brand that people seek after in those foreign countries want, then let them do that. I mean, there's certain people that like German-made cars. They like Mercedes and certain European makes because somehow the stigma is that the engineering's better and the cars are cooler and they go faster because they were built for the Autobahn. You know, we have that thing where we want their stuff too. Well, everybody's going to still want our stuff. We're still going to want everybody's stuff. Why can't we just trade and let everybody thrive? Now, most of the other countries, and I can't say that our country is any more benevolent or any less benevolent than other countries or more, but what I mean is sometimes these other countries charge tariffs, and I don't know if they really help the business community in those countries or if they just go to pad the pockets of the leadership. But of course, we've seen a lot of our own politicians doing a lot of pocket padding with insider trading deals, NGOs that they're members of or board members of, or getting kickbacks and selling influence, et cetera, et cetera. So it's not like government in and of itself is always the benevolent society that we picked it to be for us, or the guardian that keeps tabs on everything, is accountable and responsible. But at the same time, I think making trade more fair, more free, it does have a nice ring to it. I think it will help everybody, not just America. But if it can lower taxes here, I think Americans can thrive better. We can feed our families better, retire with more peace of mind. The stock market will be a little bit more stable. The problem we have to change, though, that we haven't been able to stop when we do these tariff games, is countries can manipulate their currency by just devaluing it. So it kind of wipes out the tariffs on their end and making us have to pay more for stuff anyway. So there's ways that they can play the game back. It is a trade war, and there is reason that we should be worried. We elected Donald Trump to do a job because he has some expertise and experience on a macroeconomic level that most normal people that have served in government don't have. And hopefully he'll get us through this, and it'll just be kind of that painful recovery after the surgery that he was talking about. You know, it's like you go in for a surgery, you're down for a while. You might not be doing well. I had a friend that had carpal tunnel syndrome and had his hand operated on, couldn't golf for like 6 months. I mean, the poor guy, a great golfer, a good friend, and I really miss golfing with him. But sometimes we have to go through the recovery period, and I think the economy is going to do the same.
Well, Keith, we appreciate you listening to us there in Oro Valley. I think the consensus is it's never a bad thing to take profits, but also maybe you should be a bit more diversified. If you'd like to talk to Jeff, 520-780-9059, 520-780-9059. We'll send you out Jeff's book, Retirement, The Road Ahead. Next question, Jeff, is Dennis in Tucson. Dennis writes, I encourage my wife to take a $40,000 Roth conversion in a lower tax year. Even though she has another Roth IRA at a different broker, she was encouraged to keep the money where she already had her 401k, which we converted to an IRA and then to a Roth IRA. She's well past 59 and a half. The 5-year waiting period is over on her original Roth. Does she really need to wait 5 years on the second Roth?
Well, there's two things I just want to clarify that are commonly misunderstood about Roth IRAs. The 5-year ticking clock is 5 years from the original opening of a Roth, even if you only fund it with $5. It doesn't matter. You can do as many new Roth accounts or conversions as you want after that. That 5-year rule still holds true to the first one. The other thing is even during the 5-year period, you can pull out all the money that you've paid tax on. In other words, you can pull out all your principal. You just can't pull out the interest that you've made. So you can't cash the whole thing out, or you would pay a penalty on the interest that it made. So if you put $100,000 in and it's $120,000 in your third year, you can still pull out $100,000 of it. You just can't touch the other 20 for 5 years without a penalty. And the penalty is only on the amount of gain, not on the amount that you pay taxes on, because you've already paid taxes on that money. That's basically yours. The IRS said that's tax-free money to you now. But for the growth to be tax-free, you got to wait that 5 years. Anyway, hopefully that answered your question.
Dennis, thank you so much for listening to us in Tucson. And again, 520-780-9059 is Jeff's number if you'd like to talk to him about that. Next question, Jeff, is Les listening to us in Green Valley. Les says, I'm 63 with $1.7 million in a retirement portfolio, mostly held in a traditional IRA and 401k. I max out my contribution to a Roth 401k and have $1,100 per month mortgage at 3.1% and $25,000 in a CD ladder. My father passed away and I inherited $80,000. What are my options for investing this money inside or outside a retirement account? It's hard to look at what's happening to my retirement savings in recent weeks. Frankly, I'm terrified.
Well, sounds being 63 and probably close to retirement. You got a retirement portfolio that's, 1.7 when you wrote the question and sent it in, but not sure what it's worth today. It's probably, you have a right to be terrified. You've got a lot of money that you could live on, and you've got a lot more to lose than most people. So if you can afford to lose it, write it out, or you're going to work another 7 to 10 years, it doesn't really matter because you've got good pensions and other things coming in, and you've got really reasonably priced mortgage. 3.1% is really good, and you've got some cash on hand to cover you if you lose your job for a few months. But what are you going to do in retirement? How much are you making now? Do you have any of that 1.7 million that's set aside to provide guaranteed income for life? Have you thought of that? Maybe you should take $1 million of it off the table and play with the rest. That way, if the 700 that's left goes down 50% in the market correction, then you lose 300 rather than 800. So you can protect the profits. We're still at a point in the market where we're high. As I speak now, we're over 5,000 on the S&P. And not too long ago, it was about half that, right? So, you've made some money in the last 8 or 10 years for sure. Nothing wrong with taking profits and letting the rest ride. But if the market goes down, you have to start over under $1 million to grow that back to 1.7 between now and the time you retire. You might be hard pressed to make it back in time before you have to start using that money. So again, I'd keep the mortgage. Don't worry about that. But as far as what to do with that $80,000, I don't know what you have other than the 100,000 and the 25 in the CD ladder. That sounds like probably a good amount. I'm guessing, at your 1.7 million portfolio, usually in your 60s, you're usually about 10 times what your income is. So I'm guessing you're making somewhere between 150 and 200 grand a year. And that 125 would be a 6-month buffer in case you needed to look for another equivalent type of a job. The 80,000, that might be additional buffer. Or what I would suggest is, since it's already been taxed, as you inherited that money, I assume it's after-tax money, you could consider more Roth conversions on some of the IRA and 401k money, not just the new money that you're putting in and maxing out, but do a Roth conversion at maybe $300,000 or $400,000. You could convert while the market is taking its dip, and you can pay the taxes with that $80,000 since it doesn't require you to pull more money out of your IRA in order to pay the taxes. And it doesn't require you to draw down your emergency fund money of the 125 that you have set aside for liquid needs you need outside of the 401k IRA money. So that's what I would do. Just consider that. Taxes are still relatively low compared to what they'll probably be 5 or 10 years from now. Hopefully some of the Trump goals will be met and we can get some permanent tax cuts. Right now, historically, we're in a pretty low tax bracket. And if you did some more Roth conversions so you can live a little more tax-free, and you took some of that profit off the table from the 1.7 and didn't risk it, you'd be set up where you get an income that was guaranteed a little closer to that 175 or 200,000 that you're making now than it would be if you just left it all in the market and took it by chance.
Les, thanks for listening to us in Green Valley. And of course, what sends you out Jeff's book, Retirement, The Road Ahead. Listening to the program today, you have some questions. We'd love to answer them for you. All you've got to do is give us a call here at 520-780-9059. Shelley will take down those questions for you. You can also go to the website, primret.com, and leave your questions there. If we use your question on the air, of course, you'll get a great answer, but you'll also get Jeff's book, Retirement, The Road Ahead. You're listening to Premier Retirement with Jeff Ogan, founder and president of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. Once again, we are offering this retirement roadmap, a chance for you to sit down with Jeff, talk about your individual journey towards a confident retirement. It doesn't cost you anything. There's no obligation and certainly no judgment. 520-780-9059 is the telephone number. When you call that number, you'll simply just leave your name, telephone number, very, very brief, about a 60-second call. Shelley will call you back during the week and set up a convenient time for you to talk to Jeff and answer any questions that you have about your retirement. Again, it's not going to cost you a dime. 520-780-9059. Remember, this one call really could make all the difference. Jeff, occasionally we get someone who says, I'm 50, maybe I'm 60 years of age, and I spent all my money just trying to make ends meet, and finally I'm to a place where I could invest for retirement. The question is always, is it too late to start? So let's talk about a late start investment plan. Really, that's a focused strategy for people who didn't get a chance to save much earlier in life, but they still want to build wealth. And even after age 50 or 60, you can do that. It is absolutely possible to catch up, especially if you do have income and a plan. So let's talk about that a little bit. Let's start off with the first way that you can catch up after age 50.
Well, I think the biggest thing is just figure out what you can afford to set aside and be consistent with it. That's really the best way to buy on the dips and do the dollar cost averaging technique that we have always talked about. I mean, you're still looking at plenty of time between now and the time you retire and have to use that money. If you want something that's passive and easy and you don't have to really worry about, you can buy ETFs that are very low cost. You can do it on a retail basis, put $500 to $1,500 a month or something like that. That makes a big difference. If you dollar cost average into the market, even if it goes flat for the next 10 years, you'll actually find out that you're up in the end of the 10 years because every time the market dips, you actually buy more shares. And in the end, you'll be a little ahead of the game. So even if the market is average 10%, even if it only averages 2 to 4%, let's say you make 5 or 6% and you're able to invest $1,500 a month for 10 years, I mean, you're still looking at another $250,000 or $300,000 potentially in retirement income that would generate an extra $1,000 or $1,500 a month, depending on how you invested it. So I know that might not sound like a lot, and in 10 years, who knows how far that'll go. But the fact is, you just really need to be disciplined. And, you know, what I think people that miss the boat do, and by the way, 50% of people that get to retirement have virtually no savings, no money invested, don't know what they're going to do, and end up having to live on fixed income, Social Security, get part-time jobs. So if you don't want to be in that category, just do something, grow it. Instead of every time you get a pay raise in your 40s and 50s and 60s, live on the same amount or live the same frugal or responsible lifestyle, especially if you haven't been able to save, and invest the rest. Don't keep on adjusting your lifestyle accordingly. It is so easy to spend whatever money you get in a paycheck. Sometimes people say, well, I just haven't been able to save. I haven't been able to save. But wait a minute, 10 years ago, you made $60,000 a year and now you're making $160,000. What happened? Did inflation really eat all that up? Well, no, but I drive nicer cars. And well, we did get a bigger house and we remodeled and added a pool and bought my daughter a horse. Well, shoot, those are all just money pits, right? So were you really responsible? Sure, you've enjoyed your nice lifestyle, but you still are waiting to get started on your retirement plan. The earlier you start, the better off you'll be. So if you're in your 30s, you can put a couple $100 away for the rest of your working life. But you wait till you're 50, so then now you're looking at thousands a year to make up the difference. Everybody gets to a certain place in life where all of a sudden the retirement deal becomes a reality. You can add more money to IRAs now than you used to. It's $8,000 a year. You can put over $30,000 depending on your match and your age and your 401k. And then if you have any extra savings, just keep on looking at options. I love the LRP for a tax-free income plan over and above what you can put in. In fact, even instead of a Roth 401k contribution, if you're not getting a match on it, or if you're just parking it in a place where you have limited choices to invest and potential risks of losing it, if you could put it into something after you pay tax on it, stick it in basically a life insurance bucket. I call it LRPS, life insurance retirement plan. Overfund it. You don't buy it because you want death benefit or life insurance. You buy the minimum amount of life insurance you can. And what that asset does is it lets you stuff as much cash in it as you want to, and it grows tax-free. You can take it out tax-free, and your heirs get what's left tax-free. And it's really win-win-win, tax-free, 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 triple tax-free, and, you know, win all the way around. So if you want to build a savings account and kind of be your own tax-free bank, consider that with extra money as well. In fact, if you are already maxing out your 401ks and your IRAs and are looking at extra money that maybe you were referring to over and above what your limits are, then consider that as an option as well. But the older you get and the closer to retirement you get, the bigger reality check you're going to have. That's true. So get on it as soon as you can.
And your late 50s to early 60s, I mean, those are typically your highest earning years. So I'll repeat what you said there for people who didn't maybe catch it. If you invested $1,500 a month for 10 years, let's say you're 55, And at the end of 10 years, you're 65 with a 6 to 8% return, which is doable. You'll have between $230,000 and $275,000. And that is not bad, especially if you are adding that to what you'll get from Social Security. So it is not too late. You talked about some catch-up contributions. Also, you could delay your Social Security, right, Jeff? Would you recommend that somebody maybe delay it until 70 in that situation?
Well, only if they're going to work till 70. I mean, it seems to me that if you're limited on your savings, you probably are going to need that Social Security to make ends meet or pay your bills. So, yeah, I would delay the Social Security until you're done working. But you might have a force out situation, like pilots have to retire at 65. Of course, they get paid a pretty decent amount of money before that. But some companies just have a rule that you can't work past a certain age. So if you already know what that is, consider what type of part-time job you're going to get with your skill set and see if it makes sense to continue to working or develop a plan. Best thing you could do is just put it out on paper. I mean, we build a plan for people in their 50s and 40s all the time. I mean, what's going to happen if you put this amount away and it grows at X amount? We can put all kinds of hypothetical scenarios in there to see what happens if, the what if, and the other what if. And when you add them all together, you might find out that none of these what ifs look like it's going to make ends meet. I'm definitely going to have to work till I'm 70. Well, that might be bad news in a way, but at least you know what to look forward to. You can't just be, oh, I can retire at 62 because I can get Social Security. Oh, I can't wait till 62. And then you find out when you're 62 that you should have saved more in order to retire before age 70. It's good to know before age 62 that you can't retire at that age than it is after that. You'd also might find out, like, honestly, more of my clients know that if they do things right, take profits off the table and solidify their replacement income with annuities and LERPs and things that are guaranteed and predictable income streams, rather than the what if the market doesn't do well and what if the market does do well type of income, they might find out that they can retire with peace of mind 5 or 6 years earlier than they thought. In fact, I've seen people that can turn pensions on early if they retire early and find out that they could actually get a pay raise if they retire now rather than work 5 more years and retire in the future. Their income might be more for the next 5 years if they retire because of the fact that they can turn pensions and other income streams on earlier rather than later. So look at the options, look at different scenarios, and let the math prove out what's right for you. How do you get the most money out of this? How do you pay the least taxes? How do you leave your heirs the most? How do you live on the most? How do you spend the most? How do you have the most peace of mind? All those things go into a plan, and you can start long before you retire.
So if you're worried about a late start investing plan, again, you can do that. You do have the time. You want to do it. If you want some help, 520-780-9059 is the number to call here at Premier Retirement Planning and Wealth Management. You've got a portfolio already. You'd like us to take a second look at that. We would love to do that for you. 520-780-9059, no cost, no obligation, and certainly no judgment. You can also find out more about us online at premret.com, premret.com. Jeff, we've covered a lot of ground on today's radio program. Again, if our listeners have missed it, we're also a podcast. Simply Google Premier Retirement with Jeff Fogan. You will find this show and many of our past shows so you can stay on top of your journey towards a confident retirement. Jeff, we're out of time for this week. I want to thank you for your time. That is every week. Most importantly, I want to thank the greatest listeners in the world, ours right here on KNST, for joining us. So for Jeff Hogan, I'm Jeff Shade. Have a great weekend. Talk to you again next week right here with another edition of Premier Retirement on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.